And welcome back once again, options traders, and happy Friday, everyone. I wanted to revisit an old topic that I've actually talked about many times, but we're going to look at it from a little different angle and ask the question, is there safety, and therefore money, in selling out of the money spreads? And I'm bringing this up because I've been hearing a lot of people in the group talking about this recently and saying, hey, if you sell these out of the money spreads, you've got a very high chance of making money. And so therefore, if you're making money more often than not, it's going to lead to a net gain in the long run. Well, that's just a really bad idea for a strategy, and here's why. So let's say that we take the 100-105 vertical spread. This might be with puts. So maybe traders want to sell this 105 put and buy the 100 put. And the reason for doing it is that this put might have still some pretty decent premium on it, and they'd like to sell it. They don't want to sell it uncovered or what's called a naked position, so they buy this 100 put underneath it for protection, and that's why our risk graph flattens out down here. But the rationale for doing it is that the current stock price, let's say, is up here somewhere. And because there's a bell curve over the current stock price, traders are saying, well, you know, there's a very small chance for the stock to fall all the way down to this strike. We can see that because everything to the left, just under this little remaining part of the tail of that bell curve, is saying there's not a very big chance for that to happen. So it appears pretty safe. And then they look at the trade and they say, well, I can make a buck and I've got a maximum loss of $4. So it seems like that you're just making a free dollar. But once again, this is an illusion for traders who don't understand how markets price different assets, including options. So why is there no benefit in this trade? Well, because prices are set according to probabilities. So let's just say that you have a 20% chance to win a particular trade and therefore an 80% chance to lose. Notice that that is in a 4-to-1 ratio. And what that means is that the probability of losing, 80%, is 4 times bigger than the probability to win. That's where that 4-to-1 is coming from. So what this means is that if you were to buy this trade or pay for it, whatever it might be, you would have to pay $1 to make 4. So on the surface, this might look good. You have only a small amount that you're spending and potentially a very large amount that you're making. But that is because you have a very small probability of doing so. And in fact, it's in a 4-to-1 ratio. That's why your risk reward is in a 4-to-1 ratio. So if you were instead saying, well, let's sell this bet, it's just the opposite. Now you're going to risk 4 to receive 1. It's just two different ways of saying the same thing. So what could you expect to happen if you took either of these bets? Well, there's a simple little calculation you can do, which I've shown before. And what it says is that if you have an 80% chance of winning, let's say a buck, we multiply those together, 80% times $1, and therefore there is a 20% chance to, let's say, lose 4. We multiply 20% times -4 because that's the amount that you're losing. We multiply these together, we add them up, what do we get? 0. And what that's telling you is that if you took this trade lots and lots of times, hundreds or thousands of times, this number right here, 0, is your expected gain. Now, of course, this is not accounting for commissions or any other transaction costs. It's just saying that if the market is pricing this bet to pay $1 to make 4, it's not a great deal, it's not a bad deal, it's just a fair deal. So I've talked about this before in previous videos, that whenever you see this calculation, it's called an expected value formula. It just means this is the value you could expect in the long run over, again, hundreds or thousands of tries. And if this number is 0, it's a fairly valued bet. It doesn't favor the buyer, it doesn't favor the seller. And that's why if you did this thousands of times, this might be your resulting profits or losses. So here we've got a simulation of 1,000 different tries, and here is the resulting net gain or loss. So notice that yes, over time there can certainly be areas where you are up and you're making money, and there can certainly be areas where you're down. But overall, if you sit there long enough, you are just going sideways. There's no real net benefit to the upside. There's no real net negative to the downside. It's just a fairly valued bet even though you're winning 80% of the time. So what exactly does all of this mean? Well, the key takeaway is this: don't do trades just because there's a relatively high probability to win. That is not any reason for doing a trade. Why? Because the probabilities are accounted for in the price. That's exactly what the market is trying to do. How likely is it to get this particular reward? And then traders bid up or down those prices according to those probabilities. To really succeed with your options trading, you need to ask a better question, and that is the probability for success priced correctly? That's a whole different story, and that's one we'll have to save for a future video. And for anyone who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course, Strategy Lab, and a technical analysis course. It's all at optionsatoz.com. Also, please join us on the Facebook trading group, Options A to Z, and you can find a link in the description below.